Are you getting stopped out too often when you sell credit spreads, or maybe when you sell put option contracts on stocks you want to own, but you're just stopping out too soon or too early? I've seen this happen quite a lot when it comes to people I've coached with and work with. They often get stopped out and they're wondering, well, oh man, I just keep getting stopped out all the time. And one of the big reasons behind this is that they don't understand the probabilities of how, or the chance of those stocks hitting those stops or those points or levels. So in this video, I'm going to dig deeper into the probabilities of hitting your stop and really making you realize what the chance of those hitting those stops are. Now, even if you don't trade options, this is still going to help you out. Even if you buy shares of stock and you determine or buy a stock and you put a position on a stock where, hey, this is my stop, it's going to give you a little more insight on where to position that stop and the chance of actually hitting that spot based on the options market. Now, if you're brand new here, I'm Sasha, the options coach. Been teaching people to trade options over the last decade. Got a lot of classes, courses, and many other training materials. So if you're interested, reach out down below and check out our website. Anyway, let's take a quick peek at one of the things we covered in our class on selling vertical spreads. And one of the things we looked at was really looking at the stops right here. Now, this stop that we talked about in this class was, and we can start it with just looking at a simple stock like Netflix or even Microsoft in this example. And let's say we look at even just buying shares of stock. So if we look at buying shares of stock, and you might say, okay, I'm going to check out the chart. So we've got the stock that roared up here after earnings, and you might be watching this video at some point in the future. So that's totally okay and not an issue. But you might say, okay, look, I'm going to place my stop somewhere down at let's say the lows of that previous bar right there. So somewhere around 424, 425, and I'm going to stop out at that spot. Okay. Now, if you position that stop at 425, let's just say for conversation's sake, 425, and we go into the options market. So again, I'm just referring to just looking at stock. If you bought stock ownership and you positioned at 425 over the course of Microsoft, over the course of these 34 days, okay, positioning it at 425, that gives us a delta here, okay, looking at the options market, delta of 0.35. Now, a probability of touching is usually about twice the delta. So my chance of hitting my stop in the next 30 days is 76%. Now, what does probability of touching mean? Well, when we look at probability of touching means it kind of can get there and hit it. So if you're stopping out at a certain point, it means you actually will get stopped out. It means it can get to that level. It doesn't mean it'll expire there, but it'll get to that level because you have different things in here. We've got a probability of in the money, okay, and that'll be referred to basically your delta. It's very similar, it's a little bit of a different formula, but it's very similar and close. And then twice the delta will be the probability of touching. So if you don't have these functions in your trading platform, just use the delta, and then you could double the delta here. Gives you the probability of touching, or the delta will give you the probability of in the money. So if I position at 425 over a 34-day period in the next month, that chance of touching that is actually 76%. So I'm basically getting stopped out 76% of the time. Okay. In this case, if I'm holding a trade for 30 days. Now, if I'm holding it for, let's say 6 days, okay, let's just go to the 6-day option market. So you might be just holding shares of stock, and I've got a 6-day options market, and we're looking at 425. So we go to the 425, or the next 6 days, actually have a 48% chance, almost 49% chance of getting stopped out. So if you're setting up a stop, and you're saying, I'm going to go to the 425 to get stopped out, you actually have almost a 50% chance of getting stopped out. And this is why so many people fail when it comes to trading, is they don't realize and recognize the chance of getting stopped out in a lot of cases is actually high. Now, your success of that trade being above that level is still, this is probability of in the money 24. So probability of out of the money will be higher for you. So here you actually have a 75% chance of it actually winning out okay, but the chance of getting stopped out is still at 50%. And that's what people fail to realize and recognize, because when you fail to realize that, it means you're getting stopped out quite often and frequent. So my point here to you is that when you go in, and even if you're just buying shares of stock, realize your chance of probability of touching those levels, and you can use the options market to do that. That's pretty cool, right? Now, if you were selling option contracts, let's say we go into this 6-day again, and we said, okay, well, I'm going to sell, and you can say, okay, I'm going to sell maybe the 410 or 420 in this level. So I'll go in and do a 420. And over here, by selling this option premium, your chance of actually winning this trade, okay, not winning, but actually going all the way till expiration, full probability of out of the money, you have an 84% chance. So that's pretty good, right? That's at expiration though. But the probability of touching that level is still 32%. So hitting that 420 level is still 32%. That's quite high for some people. They might say, oh my goodness, I can actually hit there. Now, that could be between now and expiration, and you could get out of it sooner. It doesn't mean that the trade's not going to be profitable. It just means your chance over the next 6 days, you still got a 32% shot of even getting there and stopping out. Okay, so that's why if you position that stop there, ooh, that's the point you'd get out. It's a 32% chance. But you might be actually selling the 420, but your stop might be around 425 or even 430. And in that case, you're stopping out is going to be around 71, 72%. So even though I am selling this one, if I'm stopping out at 425, my chance of stopping out in this case at 425 is still a 50% shot. So that's what I mean is that if I'm selling this option contract and you think you have higher odds and chance, but your stop is sooner or earlier, you're actually looking to get out of that trade and you got about a 50-50 shot of getting stopped out. And those are not really great odds. So my point in sharing this with you is to understand and recognize that those levels where you set a position or mental stop, they will be tested in a lot of cases. And you need to be comfortable with those levels of, hey, this has a pretty significant chance of it getting stopped out. And if you don't like those odds, well, you can also change days or outlooks on those. You can also try different strategies. But the point is if we go to 20 days now, and we say my stop is 425 and I'm willing to hold this longer, my stop is actually has an even a higher percent chance of getting triggered, because now what's happening is that now I'm giving that stock 20 days to reach those levels and getting stopped out, which means I'm actually increasing the chance of that stop being triggered. I've got a 71% chance. And if you go to, let's say, 34 days at 425, your chance is going to be even higher. You got a 76% chance of getting stopped out. So the longer you're in the trade, the bigger the chance of that actually getting stopped out. So this is the thing that you have to really realize and recognize when you're doing these types of trades. So what is it that you can do? Well, you could go in and predefine your risk a little bit more. Let's say we go to a 20-day and now we can go to a vertical spread. And the vertical spread, you might say, okay, well, I am going to do this out of the money vertical spread, but I'm not actually going to use a stop as much over here. I'm actually going to let the thing be comfortable with going against me all the way. And I'll define the stop based on my percentage of loss. So you could define it a little bit more that way rather than defining it based on an actual stop out at a certain price level, because that level, this level at, let's say we go into 425, it can be breached. Even the 415 can be breached. Even the 405 has a chance to be breached. But if you are the one that is able to stand the pain longer than other traders, you are the one that usually will survive and be more successful. Because in this business, if you can sustain the pain longer than other people, that's usually where you make your money. It's usually where you become more successful. So if you're saying, okay, I'm willing to hit or take the pain of $200 on this type of trade, well, that's usually more than what most people are willing to do in this type of trade. You will probably be more successful because it could come down here and touch this level where most people will freak out and stop out. And then it could whip back the other way and become a successful trade. You could also change the strategy game a little bit more, where you are doing things more like an at the money vertical, which is still a bullish directional bet. But in this case now, what you've got happening is that this trade, the risk to reward, it's a little bit after market hours, so it's not perfect. Let me see if I can line up something a little bit more like this. The risk to reward, you're risking maybe only $200 for a potential reward of $300. So the risk to reward is very favorable. And in this case, you can actually let these trades fully expire. So even if it goes against you and you're down maybe $120, well, it's not as bad or nasty as an out of the money vertical spread. And then when you win, you actually win quite a bit because your risk to reward, it's not quite 1-to-1, but you're kind of in that zone or area. So this is also also another fantastic way to predefine your risk, because now the stop is defined by actually the max risk of the true trade. So this is really fantastic in looking at it from a mindset of not worrying or stressing about stopping out mentally, because the stop is predefined and embedded within the trade. So that's pretty cool. So anyways, when we look at something like this, this is how you can start to become a little more fearless. And if you're fearless in trading, that's really where you're going to get a bigger and better edge in these types of trades. You won't have to worry or stress about getting stopped out. You won't have to worry and stress about like the fear of it, because you've already predefined your risk. But this is exactly where a lot of people lose, because when it hits their stop, they get out, but they don't realize and recognize that the chance of hitting your stop is actually quite high. So if you can define those things a little bit sooner, and if you can create and set up strategies and structures for your trades that actually handle these types of things and withstand these types of moves, then you'll be a much better trader. You'll be way better off, because you'll be able to handle the fear or other things that come your way, and you won't be sucked into the fear of getting out of those trades too early, when in fact just coming down into those stops is just part of normal conditions that are happening in the marketplace all the time. Anyways, I hope this helps, gives you a little insight. If you're joining me in one of my future classes, that'd be fantastic. But if not, enjoy the free videos and content, and I will see you on the next one. Thanks again, and don't forget to check out our website for some other free goodies, PDFs, cheat sheets, worksheets, and free live trainings. All right, thanks again, and I'll see you on the next one. Take care.